Welcome to Insights Over Coffee, the podcast where we strip away the buzzwords and dig into the forces shaping markets and investing. I'm your host, Sahhar Saleh, and today we're talking about one of the most misunderstood and most dangerous forces in finance, leverage. It's woven into nearly every corner of finance: mortgages, corporate debt, derivatives, and even the hidden plumbing of markets. Leverage is a multiplier of wealth, of risk, and sometimes of collapse. It has built empires, toppled banks, and triggered crises that reshaped the global system. Yet for those who master it, leverage can transform ordinary strategies into extraordinary performance. Today we're joined by Peter Mezzomo, a portfolio manager at Lake Geneva Investment Partners, to explore this powerful force and its role in shaping risk and return. And as always, stay tuned until the end of the episode for our segment, Signal or Noise, where our guests will weigh in on whether the current wave of credit-fueled growth is sustainable or just the next bubble waiting to burst. Before we begin, a quick disclaimer: this podcast is for informational purposes only. Nothing here should be taken as financial or investment advice. Please consult a licensed financial advisor before making any trading or investment decisions. So to start off, what is leverage and why is it so tempting for traders and investors?
Hey, Sarah. So leverage is using borrowed money or certain derivatives to increase exposure on a certain asset. It's tempting because you get the feeling that it's kind of an easy way to get rich, but you don't think of everything or all the negatives, let's say, that surround the word leverage.
So it's like a get rich fast scheme.
To certain people, it's exactly that. It's a great idea because, you think, okay, with 100, I could borrow some money and make X times more money, which, sure, it can happen, but it's not always the case.
So why does leverage have such a double-edged sword reputation?
It's a double-edged sword because it never takes much to actually lose a lot of money. For example, let's say you're 2 times levered and a certain stock, and you go all in on one stock or or any other product, and the product loses 50%, you're essentially wiped out. You're left with zero.
Because you took twice the risk.
Because you have twice the risk. When you have twice the risk, it's very easy to lose money, and people don't necessarily realize it. You take leverage because you think you're there you're the cleverest guy in the room, you're going to make money, you have a great idea where, okay, I own X stock, let's say it's worth 100, and you're pretty sure it's going to 200. So you're like, okay, let's lever 2 times, 3 times, and maybe you're right in the end. But the path could be 100 to 120, and then it drops to 60. And that's where you get margin calls, you need to add collateral, and it's just a mess. So your final, let's say, idea could be correct, but if your path is incorrect, leverage will essentially maybe not wipe you out, but force you to sell out
Before reaching margin call.
Correct.
And can you think of a time when leverage seemed harmless at first, but later snowballed into a major problem?
So there was an event in 2018 that's actually commonly referred to as Volmageddon. It involves a product, an ETN called XIV. This was a product issued by Credit Suisse and was meant to replicate the inverse of VIX futures. VIX futures are already, kind of a levered version of equity because you're trading the VIX, which is a derivative of the S&P. And what happened then is throughout, I think, 2011 to 2018, this product made a killing. We lived in a very low volatility environment, and people were very happy just buying this product. They made about 10 times their money over those years, and it ended up being a very crowded trade. It was probably worth, or let's say, it had about $2 billion in assets, and And one day in 2018, I think it was in February, what happened was the S&P dropped, I think it was about 4% intraday, and this product essentially blew up. The VIX went up over 100%, and investors were actually left with zero. There's nothing left. I think it was down 96%, and after hours or the next morning, Credit Suisse actually decided to cancel or to force redeem the entire note.
And no one was ready for it? Like, did you see it coming?
You don't see it coming, no, because you're making money daily, small bits every day, shorting volatility, and one day it just blows up in your face. The main problem with this product was how it's constructed as well. It's an inverse ETF, which means, it replicates the inverse performance of the VIX futures, but it resets daily. And this actually leads to a compounding effect where your losses could really balloon as well.
So, is there a way to use leverage in a low volatility market and be successful?
I mean, you could always use leverage if you want, sure, but the problem is, volatility isn't predefined. When volatility is low, people, funds, everyone could pile in and lever up. You lever up because you want to juice your returns. We live in a world where you want to make more and more and more money for you, for your investors, and it feels good. And the problem you get is, okay, markets are calm, but what happens if volatility rises?
It's unpredictable.
I mean, it's unpredictable, and then everyone is forced to delever at the same time, which makes stuff 1,000 times worse.
And what happens when multiple players in the same chain are all leveraged at the same time?
Nothing good. Honestly, nothing good. There's a case in the UK with the pension funds a few years back where they used something called liability-driven investments, where they essentially tried to hedge their interest rate risk by purchasing long-dated gilts. The problem you have there is that the funds didn't actually buy gilts outright. They used certain swaps or derivatives to get exposure. Why do that? Well, they do that so they could only post a bit of collateral for those products and then use the rest of their portfolio to actually invest in equities or alternatives to make more returns. And you get problems there when a certain mini budget was announced and there was no information on actually how to fund it. So the market started to panic. The yields on gilts actually rose substantially, which forced these funds to sell their holdings, which pushed the yields even higher. And it really is a negative feedback loop. The only way for it to end is to have a certain catalyst or someone to save them. And in this case, the Bank of England stepped in and bought the bonds or bought or had a certain program in place to buy, I don't know, certain hundreds of pounds worth of securities. They kind of averted the crisis.
And do you think people learned from this mistake?
No. I mean, people learn, but memory's very short, I think. So, I mean, these guys were basically doing what they did to lower risk over the long term by kind of blew up in their face. It's very hard to take into account everything in the past that's been negative and prepare for it. But that's kind of what we're supposed to do, right?
Why do even experienced traders underestimate the danger of leverage?
Leverage is something that's very easy to underestimate because, as we were saying before, when markets are calm, everyone thinks markets will remain calm for a long time, and that's not how markets work. There's periods where markets are calm, there are periods where they start moving a lot, where volatility explodes, and many people aren't actually prepared for that. You also have a certain degree of probably greed where everyone wants to make more money, wants to participate in rising markets with maximum leverage. Even professionals, I mean, professionals might think they're the cleverest people in the room. That's not always the case. They might be convinced with some idea, lever into it, and they were wrong, which can happen.
And there's no way to protect yourself from the downfalls of having leverage.
Less leverage. You start with a 1-to-1. You have no leverage, but basically just taking leverage on is always adding risk. It's always adding risk, especially we were talking before when the whole system is levered up. It's often it's a recipe for disaster. Now you also have some professionals start running money using vol targeted strategies.
What's that?
These are strategies that adapt their exposure depending on market volatility. So if volatility is low, they will up exposure to kind of get the same level of returns. And when volatility increases, they will cut the risk. Same reason, to try to deliver the same returns, which is that when volatility is higher, you can make or lose more money.
Okay, so I guess taking on leverage is also understanding if you are mentally and financially prepared for that risk. If not, then you should step away from it.
Generally, depending on your strategy, leverage can be a good idea. You never want to be 5 times levered, 10 times levered, because when you're so levered, you need, or let's say, you don't need much to go wrong to blow out. That's the main problem.
And why is leverage so addictive, even after painful loss?
So leverage is addictive because I think we forget. We forget what happened in the past, and you could be on a good streak, you could be making money, and it's very easy to lever up again. Because I think people, you're generally greedy. You want to make more money, and you think it's a good idea. You think you're a clever guy. You think
you know everything.
Yeah, you think you know everything. Nothing can beat you until reality hits. You get market sells off massively. You get big margin calls, and you imagine you're levered 3 times on certain stocks, and the market drops 20%. You're down 60%. Many people, they probably think, like, they don't even think they feel so good when you get a win, when you get a big win, that it's hard, to go back to small wins. Imagine, you make 50, 60%, 70% in a few months. It's hard to take your money out and go back to making maybe 2, 3, 4%. It's very addictive, especially for, let's say, non-professionals. People normally don't really, let's say retail doesn't have much risk management, or most people don't, and they're happy going all in on stocks with leverage, and it often ends badly.
And what is this about leverage being in mortgages?
Leverage being in mortgages, are you referring to what, stuff around 2008?
Yeah.
So the problem back then was that individuals took out mortgages, on leverage, of course. These mortgages were then resold. I think the banks resold them to other banks or certain hedge funds that added more leverage on it by creating structured products on it, which were then traded, and you don't need. It's you're basically piling leverage on leverage, and that's often when you get a small hiccup. In this case, here housing prices just started to drop. You didn't need much else. You're kind of building house of cards where as long as prices go up, it works. But a small tick down and disaster could happen, which is what we saw.
And how can traders and investors use leverage responsibly?
You have certain strategies, that are very well predefined, very well stress tested, where sure, they're running a lot of leverage. Sometimes you have to run a lot of leverage. When you're trying to make a few basis points from a trade, you could run 10, 20, 30 times leverage, because the volatility on what you're trading is so low to actually get some worthwhile returns. You have to up your risk. There's no other way. But let's say that's a niche. It's not everywhere. But honestly, the only way to make money using leverage is not use excessive amounts of it. There's no secret. You can't run a 2 times, 3 times levered book. You can. It's just that your risk is exponentially higher, which, if you look at the system as a whole, um, it gets even more complicated, because you're not the only person trading. It's not just you. It's an ecosystem with thousands, hundreds of thousands of people. Who have their views and their opinions and make stuff move. Using any type of leverage is a big risk, because you don't know what's happening around you. I mean, look what we had in the last 4 or 5 years. You had COVID. That wiped out probably whoever was leveraged. Not everyone, of course, because, you get risk management where you cut risk, you get margin calls. If you can't, you have to cut your positions. But those are cases where even if you have a small amount of leverage, it can get you out of the game. Tariffs. We had tariffs 3 months ago, 4 months ago. That was a similar situation. The market dropped so fast, so drastically, and no one expected it. And that's the big problem with leverage. It kind of hits you when no one's expecting it. The pain from it's temporary, but many people get wiped out by it. So there's, if you lose all your money during some blowout event, I mean, there's nothing to come back to. So it's only the people who manage to survive it. And, here it's the market's a game of survival over the long run. You have to be clever enough to make returns without not taking too much risk, and not blowing up. That's the main key.
And why is understanding other people's leverage just as important as knowing your own?
I mean, as I was saying before, because we're in an ecosystem, so whatever happens to certain groups of people in the market can affect what happened to you directly. Going back to what happened in the UK with the pension funds, where you could be owning bonds and you get caught up in this mess. It has absolutely nothing to do with you. But if you're levered in this, you'll get hurt. I think, many low-risk funds got killed as well, just because the whole system came down. And you have many events like that, so... And we'll continue to get them, that's
the reality of
the reality of the markets, yeah.
What an interesting topic. Now, before we wrap up, it's time for our tradition here on the show, Signal or Noise. Here's how it works. I'll share a headline that's been making waves, and our guest will weigh in on whether it's a true market signal or just background noise. But first, a quick disclaimer. Everything shared in this segment is for informational purposes only and does not constitute investment advice. For any financial decisions, please consult with a licensed financial advisor. The headline reads, "Is hidden leverage an accident waiting to happen?" So, Peter, is this sounding an alarm about hidden leverage in hedge funds, family offices, and private credit? Basically, risk building up in places regulators can't really see? And could this be the next big financial time bomb, or is it just another case of people worrying about shadows in the market? Signal or noise?
So that's it's an interesting headline. I mean, we've always had leverage in the system, probably not as much as we have now. So it all depends on if there's a huge triggering event that could actually create something enormous, or if over time leverage slowly just seeps out of the system. Which could happen, have a kind of a calm deleveraging event over multiple months or years.
And that's a wrap for today's episode of Insights Over Coffee. Thank you, Peter. I hope this conversation with Peter Mezzomo gave you a clearer look at leverage, how it quietly shapes risk and return, why it can be dangerous if misunderstood, and how, in the right hands, it can become a powerful tool. If you enjoyed today's discussion, make sure to follow, subscribe, and share it with anyone who wants a sharper perspective on investing. We'll be back soon with more conversations on the forces, strategies, and ideas shaping the markets of tomorrow. Thank you for tuning in, and until next time.
Thanks, Sarah.